Good day, everybody. This is Jim Sloman speaking. In our commentary today, we're going to look at the role of debt in what is happening. We open our commentary this time by showing a chart of debt growth since 1952, divided by GDP growth during that time. This growth of debt at rates far faster than economic activity is at the core of the financial and economic problems in the U.S. and Europe and the rich world in general. Why? You see, when debt grows at a faster rate than the underlying economic activity, it's exactly like a heroin or cocaine or meth or name your drug addict. Over time, the effect is less and less, as you can see clearly in this chart. The chart shows the effect in additional GDP for each new dollar of debt. Moreover, the increasing mountain of debt acts as a greater and greater drag on the economy. See 2011 on this chart? That's where we are now. Each new dollar of debt adds about 8 cents to GDP. At some point, the game just ends, and you have a debt crisis, as we're seeing now in Europe. Meanwhile, you can see the hollowing out of the real economy in the U.S. and its replacement by the so-called FIRE economy, finance, insurance, and real estate. We can build all the McMansions we want, but it doesn't add to the productive capacity of the economy. We can push around all the super sophisticated financial products we want, such as the toxic securitized mortgages, but that doesn't add to the real economy either, as we discovered in the financial crisis of 2008. This just results in more and more distortions in the economy and, of course, in higher bonuses for money center bankers. This chart dating back to 1940 shows the average annual increase in real GDP. As you can see, the increase has been steadily decreasing since 1950 and is now decreasing at an accelerating rate. This is very much in line with the rise of financial services to dominate the economy and, concomitantly, the incredible rise of more and more debt. If you want to understand one of the things driving the Occupy movement, just look at this chart. While incomes for the bottom 90% have stagnated since the 1970s, income for the top 1% and top 0.1% have skyrocketed. This has also paralleled the rise of the financial industry as the dominant factor in the economy. Just as private debt has skyrocketed, so has government debt, as this chart shows. This is not a new phenomenon. Indeed, it's been happening since the 1970s, but of course the amount of increase has become staggering in recent years. The only thing I disagree with about in this chart is the word doubling. It seems like a heck of a lot more than that to me. This interesting chart shows what one aspect of the problem with U.S. federal government debt is, namely that most of the spending of the federal government is mandatory, with only about a third of it discretionary. The rest just keeps growing automatically like a weed. And defense, which is viewed by many as untouchable, is almost 20% of the budget. That leaves about 16% for budget cutters, which is essentially an unworkable situation. Now, while we're on the essential subject of debt and its effects, let's shift our attention to Europe. This chart shows the amount of government debt as a percentage of GDP for some of the problem countries in Europe. The danger zone is considered to be about 80%, which, as you can see, is now the average in Europe. For those who might be wondering, the U.S. is up around Ireland and Portugal. Our time is coming. For those who might be thinking, my life is going along pretty normally, what do European bond yields have to do with me? This chart is for you. As you can see, the Greek bond yield is closely correlated with new car registrations in Greece, shown on an inverted scale, and more generally with the Greek economy. As bond yields rise in Europe generally, so its economic activity is declining in inverse relationship. As Europe as a whole is the largest economy in the world, this will dramatically affect the rest of the globe. This chart shows Italian bond yields, which are basically oscillating now between 6 and 7%. The media talks about bond yields, but what is usually omitted is that this means a dramatic decrease in the value of these bonds, since the price of bonds is inversely related to yields. The value of European bonds has been declining dramatically lately, which drastically affects the asset values of many European banks, pension funds, insurance companies, and others. Perhaps that's why many European bank stocks have been diving for the floor lately. Meanwhile, this photo shows the basic stance of most of Europe's politicians, but it could just as well represent the stance of national politicians in the U.S. as we face our own situation. Make no mistake, the situation is too far gone. Europe is either going to suffer a massive economic crash, or it will experience unlimited money printing and go through a currency collapse. Germany's politicians, with good reason, are afraid of the latter because of their searing experience of hyperinflation in the 1920s, while most of the rest of Europe is afraid, with good reason, of a repeat of the 1930s. But in my opinion, one or the other is now inevitable, and probably both, the first followed by the second. For those who may think that what happens in Europe will stay in Europe, this chart may prove interesting. It shows the increasing correlation among the world's economies. As you can see, the world's economies have become increasingly synchronized, so that what happens in Europe will inevitably affect the rest of the world now. This chart shows the correlation between Europe's banks and U.S. banks. As you can see, the correlation is 0.78 and climbing. That means they're highly correlated. What that means in turn is that the contagion now infecting European banks is definitely going to cross Europe's borders to the U.S. and the rest of the world. Unless the European Central Bank opens up the floodgates of money printing, we're looking at a worldwide banking crisis, which in turn will probably lead to worldwide money printing at volumes and levels that are likely unimaginable now. What will a worldwide banking and financial crisis mean for the world's stock markets? I'll leave that to your imagination, but it may look something like this. Personally, I don't want to be anywhere near this bear cavalry when it's charging, if it does, and you may not want to expose yourself to it either. As a slight revision of the old saying goes, you may not have seen anything yet. In closing, I'd like to read you today a quote from the Buddha, who lived from about 560 to 480 BC, and, in my opinion, was not only fully enlightened, but also one of the brightest minds ever to exist. Here it is. If you make the effort, if you take the time to light a lamp for someone else, it will also immeasurably brighten your own path. That's all for today. May every possible good fortune be yours. Until we meet again, bye-bye now.